If you're new to this style of trading, or if you've been around for a while and you just don't know, sometimes, and a lot of times, these first red day and first green day signals do not play out the way that is expected. Obviously, after a first green day, you're wanting the market to follow through the next day and go to the upside. And after a first red day, you would like it to follow through to the downside. However, sometimes it goes vertical in the wrong direction. And why does that happen? The first thing you need to understand is what are the three things that markets do. They either break out, pull back, and trend, reverse, or they stay inside of a trading range. And that's going to become extremely important when looking at why these signals are actually failing. So if we're going back a little bit, we're going to do a little refresher. What is a first red day? What is a first green day? Talked about this last week, and I've got plenty of videos on my channel to define and look at the characteristics, but going over A, B, and C. Large range pumping day for first red. Then you have a day that attempts to go higher in the mornings, closing near its lows in the afternoon below the opening price for that day. That is the first red day behavior, and then looking for that follow through on the next day. Same thing with first green day, but in the opposite direction. Large range down close day or dumping day. A day that attempts to go lower in the mornings and closes near its highs in the afternoon, closing above that opening price, giving you that first green day and looking for follow through on the next day. Before I continue, I want to go back to this the market only does three things concept so that there's a really good understanding of it because it's the entire base of this style of trading and just trading in general. It doesn't matter what style you're trading, you need to understand this phrase or term or whatever and what it truly means, and also the fact that the market is fractal. Everything happening on a higher time frame is happening far more frequently on a lower time frame. We could be in an uptrend on a monthly chart, but on an hourly chart, we could be in a downtrend. We could be in an uptrend on an hourly chart, but on the 1 minute chart, we're in a downtrend, making lower lows and lower highs, which would probably just be a pullback. But the concept of things happening on higher time frames and lower time frames, it can become very confusing unless you pinpoint how to actually use the information. So let's go back to the market only does three things: breakout, trend, reverse, and stay in a trading range. I'm going to draw a high here, and I'm going to draw a low. Now, remember what I just said about fractal markets. The fact that everything happening higher is happening far more frequently down low. So that means that it doesn't matter what time frame high and low I just drew. It just means that I'm drawing a high and a low, and the characteristics are going to remain the same of what happens next. So let's say that this is a 1 minute high and a 1 minute low, and the next bar forms and breaks out and closes higher than that previous high of a 1 minute bar. Well, now we're not in a trading range anymore because we've broken out to the upside and closed. So now we're going to look at two different options. It's either going to pull back. It could be in one bar. It could be in the wick of the next bar. And then we can see a continuation to the upside. That would be breakout, pullback, and trend. We might see maybe a breakout that goes up here and maybe does a little something like this and then reverses back into the range. Maybe we have the next bar just reverses back down into the range. Now, that being said, hopefully you're seeing a little bit of similarities compared to just looking at a normal chart. Wow, that's a previous day's high and a previous day's low. And then how are the templates building? And that's what we're kind of going into and talking about. So let's make this relevant to what we're actually talking about, which is first red and first green day traps. So if I have a breakout to the upside, I'm just using a lot of upside examples. It can go in either direction. So let's say that this is a previous day's high. It doesn't matter what day. It could be Friday, it could be Monday. And we break out to the upside and they close. They close the market in breakout to the upside. Now, on the next day, let's say that the market then breaks out of the previous day's high and gives a first red day signal. That being said, I have a breakout to the upside and this level needs to be projected across. What if this is just breakout, pullback, and then continuation, but over the course of a 3-day template or 3-day cycle? So this breakout and then a first red day, maybe this is a large range day, and then we have our first red day and we're coming in over here and looking for, oh man, I'm trying to go short, and it does maybe a little something like this and then goes vertical. It's like, well, what the heck happened? That is why my primary level for looking for these first red and first green day traps is going to be the closing price from either 2 days ago or maybe the day prior. So I'm taking these trades off of that level and that level alone, And I'm paying very close attention to this. And then also the other thing, I'm going to slow down and say this. If you have a maybe like week 1 or week 2 of breakouts where the market is moving in that direction, and then you get a first red or first green day, yes, that first red or first green day absolutely 100% could be setting up. But you're in an up moving market, so you want to be very careful of this same exact template here. Maybe it's just a pullback. You get a first red day and you're like, oh, here we go. But you're in breakout to the upside, and you got to be very careful of that. There's a very good high probability of these traps occurring if you're in a directional move to one side or the other. Some people like the paint, some people don't. So let's take a look at kind of what I'm talking about with actual real world examples. So this is 3 things that markets do example. Breakout, attempted to go above previous day's high and failed. All right, then we go back down, we try to make a new low, and that also fails. So then we go into consolidation, and then we get a breakout that succeeds. They closed outside of the previous day's high, so maybe we're looking for follow through on the next day, and sure enough, there it goes. So this is all 3 conditions just within these 3 or 4 days: breaking out and failing, turns into a trading range on the inside of a high and a low. All of this is on the inside. Then we get a breakout that closes outside of a previous day's range, and then follow through on the next day for the trend move. Now, let's look at the types of different breakouts. All right, so we got opening range breakouts. That's going to be your high and low of Monday for the week, right? So if you have Monday's high and Monday's low, an opening range breakout would be breaking out of the high or the low and closing outside of Monday's range. Previous day's breakout, again, it could be maybe like breaking out of Tuesday's high and closing, or previous week's breakout. So you've got the, on the high and the low of the previous week, we broke out, we closed outside of that range. Good stuff. So again, looking for these trades to come off of the close. So this is going to be your first red day over here. So look at this opening range breakout. We've broken out over here. We have a large range day. And then over here, they attempted to go higher, and then it failed and closed as a first red day. And you're like, okay, time to go short tomorrow. But sure enough, you get a ascension and a nice parabolic channel that goes vertical coming off of that nice closing price, which you can see over here. Beautiful ascending triangle, higher high, and then the squeeze to go vertical coming off that close. Good stuff. And this is actually out of my own personal playbook. I've basically took everything and broke it down into note card fashions. I took all the setups that I like to look for, and I looked at the different scenarios or variations of those setups, and I put them in note card form, which I highly suggest that all of you do as well, because it's become very beneficial and is very beneficial to me. So this is some of those variations, though, of the first red day trap. And of course, first green day trap is these exact variations just flipped over. So this is actually kind of a trap that is set over the course of 2 days. So you could have a first red day trap over here, but maybe I've missed it, didn't expect it, whatever it may be. But coming back to the details again, we're in breakout to the upside. You can tell this is, I'll put in air quotes, a strong trend in a direction. We have large vertical moves to the upside, breaking out of previous day's high and going vertical. Then you get a first red day, a day that opens, attempts to go higher in the morning and closes somewhat near its lows in the afternoon, closing below that, opening price for the day. Maybe looking for that sell short on the next day, which it does present as a sell short over here, which is great. But then at the end of the day, they actually break back up to the upside. So which could this be an indication that maybe we're going to continue the trend tomorrow, breakout, pullback, breakout to the upside, goes sideways. Maybe we're going vertical tomorrow. So this is one of those variations that I like to look for. We've got this higher high and 3 pushes down into the low and a squeeze coming off of that closing price. Beautiful setup right in the session. Perfect. Coming to the next scenario or the next variation of this, that last one was, a trap that was set up over the course of 2 days, whereas this one is set up just on the day itself, and it's perfect. So you can either get it from the close from 2 days ago, which I've got set up over here. You could project this level across, and maybe that's the level that needs to be watched. Or you could be using the close from the previous day, and you can just use that, which in this case, that was the one that was used. So this is, again, a strong trend to the upside, breakout. So we're trending higher. And then you get the first red day. They attempt to go higher and then closing down low in the afternoon. Now, this is also still in breakout. So if I were to project this breakout level across, they tried to break back down and then they broke back up above this line and then started to ascend. And then there's that close. And then this is a lower time frame where you can see the trap forming. They broke down and then they went into this squeeze, they make the higher high, and then there's the ascending triangle. And one thing with these ascending triangles, something that I've noted over time and that I actually really love to see, is that there's always going to be, or should be, some kind of spike first that comes outside of these little triangles, and then they slam it back down, but they make a higher low. So notice how this low is here, and then this low is here, and it's a bit higher than the previous. And then on that follow-on engulfment is usually where I'm going to take the entry when I see these, and I'm very, very confident with these patterns, not only because I've seen them work out so many times, but I've just seen the results that these produce. So I really like when I see these style of ascending triangles. The breakout kind of fails at first, but it's actually just a breakout pullback, and then it continues. Really good setup, and also this chart was very clean, so kind of a cherry-picked example, but is what it is. That's what perfect looks like. And then here's a really good example of like a first green day trap, right? Monday opening range of the week, so this was actually taken off of the high of the week as well, which is even better. You can see down moving market, we're breaking out to the downside, and then prior to this, we'd also been going lower. But for the sake of the example, I wanted to be able to zoom in on the chart. So we've been dumping down and going lower and lower and lower. And then you get a first green day, which could actually be a very good time to go long example. It's even in breakout to the upside over here. So we have a high and a low. This is where my entry criteria is going to start to come into play. And of course, the understanding that, hey, we're in a down moving market and we just got this first green day. And something that George Taylor actually has talked about, and then people, his predecessors and things, people that have studied his material have kind of talked about is, these up close candles in a down move could actually be a selling opportunity. I can't think off the top of my head. If down in the comments below, if you know who I'm talking about, please put them down there. But I think Al Brooks was one of them. So in this case, we have a first green day. This is an up close bar in a down moving market. We were making higher highs and higher lows on the day. Maybe this was the long opportunity coming off the low, consolidation, goes vertical, makes a higher high. And then once it breaks back down though, now the first green day shorting opportunity or trap opportunity might be coming into play, and I just need to wait for my entry criteria to play out. So we get the lower low, and 3 pushes back up into the high, and then the follow through coming off of that closing price from previous day and also from 2 days ago. Kind of both of those have lined up really well. So that means we might have volume trapped above those closes, and also a 3 peaks pattern above those closes to go vertical back down to maybe retest the low. And most of you have probably heard me talk about the ways that I take profits. One of those ways is using range expansions of smaller consolidations from the inside and expanding that range. And I found this to be pretty accurate. So in this case, I could have used a few different ways. I could be using previous day's levels, previous day's high and low. Sometimes I'll use the high and low of the current day. And then sometimes I feel a little bit more conservative, or a little bit, not even necessarily conservative, but more realistic. The more realistic approach would be to use the consolidation and use that as my measurement. So in this case, that would have been a fantastic way of measuring. You get this lower low in the closing price, and then as it's following through, you kind of get this 1, 2, 3 up and the engulfment to come back down. Either taking the trade from that level, which would have been the perfect opportunity to get in, or using the breakout fake out candle as it's following through, and then looking for one full expansion of that range. I'm always putting my stops above the second push. So in this case, you kind of have a 3 peaks, 1 push, 2 push, 3 push, and then ending in that 1, 2, 3. So putting my stops above push 2, because that is where they should not go back. Notice how it wicked up to that high, but did not let those traders out of the position. So there's people trapped up high in these up close candles. If I bought this bar, bought this bar, bought this bar, or bought this bar, you can kind of see that those are like the best fill for the region up there, and they should not go back up there once it starts to follow through. So that is why I use that as an area for my stop. And this is a bit of a wider view, just looking at what is breakout pullback, and market only does 3 things. What the heck does that even mean? So again, Friday, coming out of Thursday's high, this is a breakout, and we're in breakout until we're not, and it comes back down and retests the breakout level, stopping out anybody who is long on the breakout, and gives that 3 push, 3 peaks pattern, 1, 2, 3 into the low, and then goes vertical the next day, makes that higher high. You get a first green day, and then continues with the first green day. So this is an actual first green day opportunity over here. But this over here being first red day, could confuse a lot of people because the definition of a first red day is large range day, which this obviously was. This is where it opened, this is where it closed. And then on the next day, a day that attempted to go higher, which it did attempt to go higher, and then close near its lows in the afternoon. This was an inside day, but still a good first red day, also an inside day. So maybe on the next day, I can look for a shorting opportunity. But then it's working the low and failing to go any lower, which is an actual a sign of reversal. So maybe I need to be paying attention to price action and the rectangle. 1 push, 2 push, 3 push on the day, giving us a little tweezers pattern down here, and then engulfing consolidation down low, very large peak formation, staying out of the nonsense. You know, hey, this is 3 peaks into the low. Maybe I shouldn't be going short down low and getting caught. Look how strong these bars are into the low, and it's not going anywhere. It just keeps reversing on the next bar. That's a pretty big telltale sign that there's a trap in play, and I need to be either extremely cautious, or maybe it's not worth trying to get caught down low. All right, so this is breakout pullback. First red day. No, it's not. It's actually just a breakout pullback. There's the close from the previous day as well. So there's an opportunity to catch the trap on the day. And then you get a first green day to go back in alignment with breakout pullback. And then we're trying to get back up to the retest of the high over here on Wednesday, which would have been a nice 3-day template. If you've made it this far and you still feel like you don't know what you're looking for, let's do a little summary and a little takeaway. For a first green day or first red day trap, the market should be in breakout in the direction of the trap. So if it's a first red day trap, the market should be in breakout to the upside. And if it's a first green day trap, it should be in breakout to the downside. My primary area and the only area that I am willing to execute one of these trades is going to come off of the closing price from either the previous day or from 2 days ago. And there should be trap volume either up high or down low in order for me to execute this trade. I should also be in the current structure of the direction that I am going. So for first red day trap, obviously I'm looking to go long. I want the market to make higher highs and higher lows on the day on the 5-minute chart. Also, once we have those higher highs and higher lows, I can execute my entry criteria and look for a squeezing pattern around closing price, looking for those ascending and descending triangles, double bottoms, double tops, triple bottoms, triple tops, head and shoulders, inverse head and shoulders, all of those great patterns. And then an engulfment of the pattern at a certain time of day in my session, new 15-minute bar rotations, 1-hour bar rotations. On those engulfments, that's where I enter. I put my stop above, depending on direction, or below that second push, and I look for expansions or target levels, previous day's high and previous day's low. If that was a lot of information all at once in the outro, go back and listen to the rest of the video again. All of those things were mentioned, or you can just slow down the outro to 0.75 of me speaking. Ladies and gentlemen, I do hope this video has been useful to you. If it has, let me know down in the comments below. If it wasn't, let me know down in the comments below. Hit that like button, subscribe to the channel if you have not already, and I will see you in the next one. Bye-bye.